Happy morning, people. Hope you're all doing good. So in this today's session, we'll be taking up RTP September 2025 attempts. So overall, this RTP is quite good. They have added some few good questions or new types of questions has been created and added by our mother body, ICAI. So we'll be running through them. In this particular RTP, we'll be only covering the new questions. If it's a repetitive one or if a similar or same question, if it is already available in our notes, if it's already covered, we'll not be doing it here again. Only the new concept oriented questions or new questions will be covering. Yes, but there are quite a few new questions in this RTP. So let's start. First, the case-based question. Sir, they have given full story. This company is doing that to this to that to and all. We don't have time for all that. Let's go into the main macro. But as I told you, normally in case study questions, before you read the case study, have a quick review of the requirements so that you can understand the case studies better. Okay, so now they're asking some initial measurement of financial instrument. Okay, that is one. They're asking closing balance of this financial instrument. Fine. Closing balance, if you put up maybe if it is valued at ACM, then if you put up ACM table, you'll get it. Then they're saying about something about joint venture, joint operation. We'll see that. And something about PPE and depreciation is there. Right, so this is the requirement of the question on a quick glance. Now let's go back and review the case study a little better now. On 1st October, in fact, for this year, this company ka financial year is ending on 31st March 20X2 is what they are saying. Okay, all right. In October 20X1, that is current year, this company, they have subscribed 40 million rupees 1 loan notes as in debenture. Rupee 1 is here stands for the face value. Okay, in Z Limited. Fair enough. Okay. The loan notes were issued at 90 paisa, were redeemable at 1.2 on September 20X6. Okay. So these particular loan notes or debentures, they're issued at discount, but they're redeemable at premium. Now, can we say this transaction has happened at off-market terms? No. Right? It is common for the company to issue the debentures at discount and also redeem the debentures at a premium. All these are part and parcel of the normal transaction. So the transaction is at market terms only. So if the transaction has happened at market terms, what do? The transaction price itself will be taken as a fair value, and at the transaction price itself, the initially that financial asset or financial liability will get valued, correct? Now here 40 million loan notes and it is issued at 90 paisa. Face value is 1 rupee, but issue price is 90 paisa. So 40 million into 90 paisa, if you do, you'll get 36 million. So initially this particular financial instrument is measured at 36 million. That's all. Very straightforward. Okay, first answer, dumber. Okay, now but this the loan notes were issued at 90 paisa, redeemable at 1.2. The redemption is 30th September 20X6, like few years later, 4 or 5 years later. Interest is payable only on 30th September in arrears. Arrears means at the end at 4%. The actual interest rate is 4%. Okay, this represents EIR of 9.9% because here it is the debentures are issuing at discount and redemption is happening at premium, right? So hence there is the actual rate and effective interest rate will not match. Here effective interest rate or EIR is given to be 9.9%. We book finance charges or finance income using effective interest rate, which in this case is 9.9%. Okay, now they ask first year ka measurement. You just need to put up first year ka ACM table, that's all. Okay, now opening balance of this financial instrument is 36 million. You will book finance charges. If it's, I don't know whom they've asked for. We have subscribed means for the person subscribing it, it will be a financial asset. For the company issuing it, it will be a financial liability. Either ways, right? So now, anyway, it's an MCQ question, so we don't have to worry about too much about format. This is the opening balance, right? If it's a financial asset, then you will book finance income. If you are doing accounting for debenture issued as in financial liability, then it will be finance charges, right? I think in this case, for this company, since they have subscribed, it will be a financial asset. So you'll have to book finance income. At what rate? Same effective interest rate of 9.9%. Take the opening balance, 9.9% you do, but be careful. This 9.9% is the interest that you will book for the whole year. But these debentures were issued or subscribed on October. Okay, for the first 6 months, it was not there. It was only there from October, November, December, Jan, Feb, March, 6 months. So you will book finance charges or finance income as the case may be only for 6 months in the current year. Okay. Then when you talk about the receipt, okay, instead of finance charges, I'll call it as finance income only maybe. Yeah, better. Okay. Yeah. It's not going. Okay, let's make it as finance income. Receipt. Sir, what about receipt? Why have you written 0? Sir, interest no. See, the debentures ka face value you will get only after 5 years. Interest you will get every year. but the company has a policy of paying the interest on 30th September. On 30th September. So one day later only you purchase the debentures, right? So company pays the interest on an annual basis on 30th September. As an investor, we purchased it one day later, that is 1st October. So next when we receive the interest, it will be what, sir? Next when we receive the interest, it will be 30th September 20x2. But our current year is ending on 31st March 20x2. Hence current year, the interest received is 0 because we will receive only on 30th September 20x2. Now closing balance, these two addition minus this will give you closing balance. So you'll have to check that is the closing balance of this financial instrument, which has that 37.782. So B or C for Chennai is the right answer for this particular MCQ. That's all. All right, moving along to the next para. On 1st April 20x1, the same company, HIG or HIG Limited, they commenced joint construction of a property with G Limited. Okay, for this purpose, an agreement has been entered into for joint operation. So they only told this is a joint operation. This is not a joint venture. This is a joint operation is what they have already told. Correct? No? Okay. Now in joint operation, we do proportionate method, right? Each venture will show their share of assets, liability, income, expense in their books. So that's all you'll have to do. All the ongoing expenditure comprising maintenance, borrowing cost shall be shared equally. That's the nature of joint operation. Everything will be shared in a particular ratio, and as per the agreement, in this case, the expense income are shared in equal ratio. The construction was completed on 30th September 20x1. You started the construction on 1st April, ending is 30th September. That's about 6 months. The construction and the utilization of property was on 1st January. That's put to use. Put to use is irrelevant for accounts. We only check the day asset is ready to use, which is 30th September. Useful life is 20 years. Okay. Now that's to construct this property. The construction cost was 40 crore is what they're saying. Besides internal accrual, the cost was partly funded by a loan of 10 crore taken on 1st January. To fund this construction, we have taken a loan. But we can't start capitalizing the borrowing cost, okay, since it's a qualifying asset. It is taking about 6 months, right? 6 months can be considered as a substantial period of time if management deems it so. In a problem, I always had told, consider it as a qualifying asset only, right? So though the borrowing cost starts from 1st January, but our current year starts only from April. So in the current year, only from April, May, June, July, August, September, 6 months ka borrowing cost you can capitalize. How much is that? 10 crore ka 10% into 6 by 12 if you do, you will get 0.5 crore. So that means what is the total cost of this particular, whatever is that, what is the building? Yes, some property, right? Construction cost is 40 crore, borrowing cost capitalized is 0.5 crore. So the net will become 40.5 crore. Okay, and joint operation wala agreement clearly says that the parties have to share all the income and expenditure, asset, liability in equal ratio. So HIG ka share of this particular property will be 40.5 crore ka 50%. Why 50%? They told clearly that these things are shared equally given in the question. So HIG ka share in this PP will be 20.25 crore. That's it. No, asset is ready to use in the current year, so we have to depreciate. Since asset is ready from 30th September, from 1st October to 31st March, 6 months you need to depreciate in the current year. Okay. Now, since they asked only HIG ka share, I've only calculated HIG ka depreciation. HIG share of PP is 20.25 crore. Residual value not given. Life of this PP is given in the question to be 20 years, but current year only 6 months depre. Do this. This is not total depreciation of the asset. This is a depre only relating to the HIG because of the requirement of the question. Okay, sir. All right. Now, what they've asked about this. One, they're saying, what is the nature of this agreement? In the question only, they told, no, this is in the nature of joint operation. So, B for Bengaluru is the right option. Then they asked, what is the PP value? PP value, initial recognition of PP. Now, they will not ask PP ka closing balance. If that asks closing balance, these two we need to eliminate and take. Okay, be careful when you're reading MCQ question. Huh? Slight words here and there can change the whole answer. In the question, they asked, what is the initial recognition of PP in HIG books? Initial recognition will be before depre, that is 20.25. So which has that? C for Chennai. Now they're asking depreciation for G Limited. Doesn't matter whether it is G or HIG. Anyway, they're sharing everything equally. So depreciation will be 0.5062 or 50 lakh something. So 50 lakh 62,500. That's the right answer. That's all. So I think we have covered all the first case ka, all the, we have read and we have covered all the MCQs as well. Fine, fair enough. Next, what we have, case scenario 2. This is a descriptive question in our book. Same thing has been made into MCQ. We'll not be doing that. We'll only be taking up the new things. Now, this second case may only, there is another part. We'll read through this part. It's also straightforward. But yeah, quickly we'll do. FA Limited, the company, they're giving some consultancy service to customer regarding some installation. Okay, we're giving some service basically. The system has caused the customer considerable problems, so the customer has taken legal action. So what service we have given is not that appropriate. So customer has filed a legal case against us and they're demanding a damages of 1.6 crore. I mean, this more looks like an Ind AS 37 provision or contingent liability wala scenario. Yes. If the obligation is probable, meaning more than 50% chance of outflow, we recognize provision. If the obligation is possible, meaning 5 to 50% chance of the outflow, then we disclose it as contingent liability. Here, what is it? The legal department of the company considers that there is a 25% chance that the claim can be successfully defended. Successfully defending means winning the case. So lawyers are saying there is 25% chance of winning the case, right? Sir, outflow will happen when you lose the case. If there is 25% chance of winning, then there is a 75% chance of losing, right? And when you lose, there will be an outflow because somebody has filed a case against you. If you lose, you'll have to pay the money to that some customer of yours, right? And there is a 75% chance of losing the case, means here the outflow is probable. For probable obligation, what we have to do? We have to recognize provision, right? At best estimated amount. If they don't give the amount, we will take 1.6 lakh itself as best estimated amount. Okay. All right. Accountant feels nothing is to be provided. Throw that accountant. He's saying faltu tha. We don't have time for all that now. Okay. So now what is a question relating to provision? So they're saying what treatment should be done. Treatment is they didn't give the best estimate. So 1.6 lakh only we'll treat it as a best estimated amount. We have to basically recognize provision with a charge to P&L because the entry is SPL account debit to provision, right? So B for Bengaluru is the right option for this particular case. Next, sir, they have given you some information, okay, and then they are asking you, I think this information looks like cash flow statement. Yeah, if you just check, we need to find cash flow from operation. So this information is given to find out operating cash flow. Since they have given P&L, we have to follow, obviously, from P&L, if you are deriving operating cash flow, it's an indirect method, basically. So using indirect method, we'll have to find operating cash flow, okay? Okay, start. They have given net income after tax, that is, they have given PAT. PAT is 120 lakh. Right, but we usually start with profit before tax because for cash flow statement we need tax paid, but in P&L we will consider the tax provision made, right? So this 120 lakh is after the tax provision, but we don't need tax provision, we need tax paid. Hence, whatever provision we already deducted, add back. That they've given here. Tax charge including deferred tax liability is 15 lakh, right? This is the total charge you have done, meaning 120 lakh is arrived after deducting 15 lakh rupees as provision for tax. We don't need that. So first add back the tax and we want tax paid. That we'll get somewhere at the end. Okay, if they give information. They don't give, it's okay, right? All right. So PAT may add back this. Then they've given decrease in accounts receivable. So we know this, no sir. Working capital changes. Decrease in current assets means plus. Increase in current asset means minus. Increase in current liability plus. Decrease in current liability is minus. So we'll have to just use this and do it. Decrease in accounts receivable. All this ka logic I told you in regular class, in inter also, in final also. Now we'll not go into all that. Decrease in current assets means add 20. Depreciation is a non-cash expenditure, add back. Then increase in inventory. Increase in current assets means minus, done. Increase in accounts payable, current liability, add. Decrease in wages payable. Wages is an outstanding expense or current liability, reduce that. Right, decreases in reduce. Okay, tax charge already considered. Profit on sale of land. Profit on sale of land is not an operating activity, it is a investing activity. But this profit has gone to P&L, hence reduce it. By doing this, you will get plus minus, you will get the net operating cash flow 170 lakh. They have not given information about tax, so we don't have to worry about that. If they had given, probably we would have worked out that, right? Tax paid, I mean. So that's the question and its quick solution. Okay. Now, sixth question is relating to, as I said, it's a repetitive question. It's already there in our class material that we're not doing it. 9th and 10th is also relating to your property, plant and equipment question, which was already available in our regular class notes. So we'll not waste time there. Okay, moving along. Question number 11. People have written as much as possible. I've written LDR. LDR as in last day revision. If I'm covering any question in RTP, by default, think of it like an LDR. Because if it is repetitive question, we will not be doing it. So I don't want to waste your time during your exam time and all. Okay. I know that most of you watch RTP and all as closer to the exam as possible, right? So by default, all questions, whatever we are covering is an LDR, even if I don't mention it, okay? And keep it like that. It's always once better to review it and then go for exam. Okay, so they've given some consolidated financial statement. One question. Okay. Now, if you just check, they've told some disposal. Journal entry for sale of 60% stake and compute gain of 40% retained. So it's a 100% subsidiary. We have sold 60%. When you sell 60%, it leads to loss of control, right? Because now remaining is only 40%. With 40%, you don't get control. At best, you'll only have significant influence. So control is lost. So when control is lost, we know the format, we know the journal entry. They're asking you the gain or loss due to LOC basically, right? You can pass it in statement or we can directly work it on as a journal entry. Since they've asked entry, we'll directly present it as entry, okay? Now, we own 100% of B. A is the parent, B is subsidiary. A disposes 60% of interest in B for 360 million. So there's a selling price. So the entry is bank account debit 360 million. As and when we see, we'll plug it off. We have done so many questions like this. In fact, this is straightforward. Just for the second part, I'm doing this question. Otherwise, I would have cut it. All right. And loses control. It deconsolidates. Yes, when you have control, you will do the consolidation. You will recognize NCI, goodwill, net assets, etc., etc. When you lost control, all that NCI, goodwill, you'll have to de-recognize net assets, etc. It will deconsolidate subsidiary and account for 40% in associate using equity method. Yeah. Associate method ka consolidation works on a equity method. That's what we will do. At the disposal date, the fair value of the retained investment in B Limited is 240 million. So the fair value of the remaining investment. Now this we'll have to show. When it was a subsidiary, we don't show investment in subsidiary in our books. Instead of that, we show net assets, goodwill, etc., etc. When it is no more our subsidiary, but when it is our associate company ka assets, liability and all we don't show, but rather we show investment. Now this fair value of the remaining investment is 240 million. It will come as investment in associate. That is one. Okay. The carrying amount of identifiable net asset is 440 million excluding goodwill, and goodwill is 60 million. We have already shown this. We need to de-recognize. So to net assets 440, to goodwill 60. Okay. Yeah, this is done. So these we have ticked off. Next, what else is there? Okay, A tested subsidiaries goodwill and long-lived assets there was no impairment. There is no impairment on goodwill, it seems. Good enough. There is 4 million credit in available for sale reserve and 10 million credit in revaluation reserve relating to subsidiary. We have already do this, right? Subsidiary ka post-acquisition reserves we'll have to record. That subsidiary ka post-acquisition reserve could be your P&L or retained earnings, or even OCI items also can be there, right? So if subsidiary has any post-acquisition OCI items, that also we will recognize. So here they are saying we have recorded two OCIs or two OCI items relating to subsidiary. One is some available for sale reserve 4 million and revaluation reserve of 10 million. Right? So this available for sale reserve, right? Okay, it's basically an investment held for sale, right? So this again, it depends what kind of investment they are holding. We know this for equity investment by default the valuation. Excuse me. Yes, the default is FETPL, but you can also go for irrevocable option of FET OCI. Right? But however, if it's equity investment or rather if it's a debt investment, right, then it could be what, sir? It could be ACM or it could be FET OCI or it could be FETPL depending on the business model. Here they have not told. Basically, subsidiary has some investment. Maybe we are valuing it under FET OCI or FETPL. So whenever if you're going for FETPL method, every reporting period will value at fair value, and fair value gain loss you will book now. If it is FETPL method, gain loss goes to SPL. If it is FET OCI method, gain loss will go to OCI, right? So subsidiary is having such investment, and relating to such investment, there is some fair value gain and parent has recorded their share. Now the question is, sir, this is OCI or this is SPL or what is all this? So our ICAI has assumed that this, since they have not given the nature of investment, we have assumed this as reclassifiable OCI, meaning we have assumed this investment to be debt. Subsidiary has purchased some debenture investment. Okay, so debenture debt investments are recognized. It's an OCI R item. If it's equity investment, then it will be OCI NR, right? All right, because any transaction between equity should never come to P&L. We have a thumb rule of that, right? So here the assumption is this is a reclassifiable OCI item. Okay, now that is one. And revaluation reserve we already know this is a non-reclassifiable OCI item. So two OCIs we have. Sir, as long as we have control, we will show all this. Once we have lost control from OCI, we'll have to release. OCI R will be released into SPL. OCI NR component will be released into retained earnings. We have done such questions also in our regular class. Basically, this adjustment used to come a lot in associate. Right, we used to record and release it, right? So same thing. Reserve means obviously it will have credit balance. So two reserves we need to cancel. 4 million, 10 million. That's what I've written. 4 million, 10 million debited. Since available for sale reserve is assumed to be debt investment by ICAI in this problem, we'll use the same for exam. This is a reclassifiable OCI R, where it will be released into SPL. But however, revaluation reserve is a OCI NR, that will be released into retained earnings. So 10 will be released into retained earnings. And this 4 will be released to SPL. All right. But anyway, when you do LOC accounting, you will get some gain loss also. And that gain loss also, where it will go? SPL. So I've got SPL as a balancing figure. Okay. So basically 100 is 100 plus 4. This is 100 is due to loss of control. And this 4 is from available for sale reserve transferred from OCI to SPL. Right. So instead of calculating, I've just got it as a balancing figure. That's what. This is a journal entry for LOC accounting. Correct. Alright, that is one part, entry we have shown. Now they're saying 40% investment you have retained. No, is there any gain on that is what they're asking. This was not there, right? This is quite common to us. We have done such adjustment, but this one was not there, right? Alright. Okay, because this is an associate investment now. Going forward, we will value using equity method, right? I had told you a simple funda. Associate ka investment should be valued based on associate ka performance. If associate company reports profit, investment in associate balance will increase. If associate reports loss, investment balance will reduce, like that. That is a subsequent accounting, right? They're not asking that. Right now, LOC has happened and 40% investment you have retained. On this 40% investment retained, is there any gain? Of course, there is a gain. How? Sir, simple. When you buy equity shares of another entity, you'll get share in what? Net assets. Now, what is the net assets of this company? So that company, B Limited, 440, but this 440 excludes goodwill. So goodwill is how much? 60. So total is 500. 500. How much do you have? 40%. So total net assets of B Limited is 500 million. And you have 40% investment, means 500 ka 40% is what? 200 million. Correct? That should be your ideal value of your investment, because as a shareholder, you get share in net assets. Right? So if this is the net assets, including goodwill, and if this is your share percentage, the value of the investment should be 200. But are you recognizing your investment at 200? No. LOC accounting says you'll have to take the value, fair value. We have to take the remaining investment at fair value. What is the fair value of the investment remaining? They only gave the fair value of the remaining investment is not 200 but 240. Carrying amount is 200, but the fair value is 240. So relating to this 40% investment retained, there is a gain of 40 million. So should we record this as a not required? This is already there. Okay, it's already included here only, because that's the reason I gave you split up. No, this is 100 plus 4, right? This 100 plus 4, remember? So 100 will include this 40, because 100 ka 40% if you do, you'll automatically get 40. Fair enough. So this 104 is a total gain. So this 40 is already included in 104. So no entry, separate journal entry is required. Since they asked us to calculate this, we are calculating. But otherwise, it's not required to be. Because going forward for associate, we follow equity method. No? So all this in a way indirectly will get accounted on the reporting date, not initially. Right? So yeah, but that is a requirement of the question. So this is the new part of this question. Compare the fair value with the carrying amount of net assets. The difference will be your gain or loss on the investments retained. That's all you'll have to do in this particular step. Easy question only. Yeah, but good one. This is the new part. Because of that, I'm making this question as a LDR. Okay. Okay, moving along. Next, question number 12. I'll again keep this as an LDR, as I told by default. Yeah, things are LDR. There's actually one super duper question. And they've given like a lot of content over here. Solution is pretty straightforward. Hardly any numbers there. But they've given so much data that it can lead to a little confusion as to what they're trying to ask. Okay. So once I will give you a read through of the question, and then I'll tell you what is the requirement and what is the relevant information we need to pick from this dump of data given. Now, A is a wholly owned subsidiary of B Limited. Okay, so that means A has wholly owned means A has 100% in B. Okay, fair enough. A Limited sells subsidiary B to C Limited. Now, whatever stake A had in B, they have sold it off to C. Okay, so A has sold stake of B to C. a listed entity for shares in C Limited and ends up owning 75% of C Limited ka shares. Okay, fine. Sir, earlier, no, before the transaction, before the setup was like this, A had 100% shares in B Limited. Now, after this transaction, what has happened is A sold, okay, its shares to C Limited. Whatever shares A was holding in B, they sold it off to C. That means 100% of B Limited is now controlled by C Limited. That is one. Okay. Now, will anybody sell the stake at free of cost or no? So A has sold B Limited ka stake to C. In return, what did A get? A ended up owning 75% stake in C. So A gave 100% stake of B Limited and accepted what? 75% stake of C. Okay. Yes, that means what, sir? Indirectly, yeah, it's ultimately A is only the parent, no? Right? Control is overall not changed, right? Essentially, if you just check, only few things has changed over here. We will see what's happened. Earlier, no, A has 100% stake in B. Now, if you just check A, okay, A in a way has 75% in B, you could say. How? Because what this 100% is now owned by C, right? Whatever C owns, 75% of that belongs to A. So this, we used to do all this in chain holding wala question. If you remember, effective shareholding percentage we used to find out. So of this 100%, we used to multiply 75 and we used to get 75%. So effectively, when A consolidates with B, no, when A consolidates with B, we'll have to show the effective shareholding percentage to be 75%. Okay. So what has happened? Earlier, A had 100% in B. Now, after this transaction, A has sold 25%, and now they only have what, sir? 75%. That's what the conclusion you can draw using this particular data. Okay, first para. The net assets of B Limited prior to disposal. Before this particular change happened, B ka net assets was 10 lakh, fair value 13 lakh, and goodwill previously capitalized, not impaired, is 6 lakh. Excluding goodwill, it is 10. Goodwill is 6 lakh. They have given. Okay, fine. Some data they have given. At the date A Limited acquired B Limited ka P&L was they have given. At the time of when A got control over B Limited, what was B Limited ka reserve they have given? These are all pre-acquisition reserves and surplus. Fair enough. Before this transaction, they have given consolidation data of A and B. Obviously, they have given A ka separate financial data, B ka SFS data, then consolidation adjustment they have given and prepared consol. All this again dump of data. Not required. Sir, how do I know it's not required? If you want, whenever they give you a big question, first read the requirement. So you'll get to know what are they trying to ask. Do we need all that? Sir, they're asking if compute gain or loss on effective disposal of B. A had 100% before. Now in B. Now A has effectively only 75%. That means how much has A sold? Effectively, A has sold 25% stake of B Limited. So when a sale happens, you will end up booking some gain or loss. No, that they're asking. For this 25% sale, how much is the gain loss? 1. And A got control over C Limited now, because A has now 75% stake in C now. A has 75% stake now. So once you get control, you'll have to apply Ind AS 103, find out record net assets, goodwill, find out all this. So they're asking compute the goodwill on acquisition of C. Check. That's all they asked. Nothing else. So one sale ka gain loss they've asked, and other company ka control you've got, and they're asking you to calculate goodwill. That's pretty much it. Okay. C is not required to prepare consolidation financial statement. Maybe they have some consolidation exemption. We have those some conditions, no, which are an investment entity, or if you're an intermediate holding company, you get CFS exemption. Maybe C falls under that category. All right. They're saying also ignore that it is not a reverse acquisition at all. Okay. It's basically normal. Control has not changed, right? Now, this is the funda, what they've given. So, all this consolidation data, what they've given, that we don't need for our information, right? We just need to compute gain or loss. So, this information, what the table, what they've given, not relevant. C Limited ka, B Limited ka net asset information they gave. Now, C Limited ka, before its acquisition, the net assets of C Limited prior to acquisition of B was 380. Fair value was 5 lakh. C then issued shares worth 17,50,000, which is a fair value of consideration given for 100% acquired of B. Now C has acquired 100% of B, no? So they have to give some PC. So they're saying they gave 17,50,000 as a consideration. Okay, but the 17,50,000 is for 100% of B, right? For the 100% B, if you acquire, the value is 17,50,000. Since C has acquired 100%, they are saying we have given our company ka shares, which is worth 17,50,000. Which is equal to fair value of the company B. Okay, keep this data in mind. All right, they're saying 6 lakh is on this 1750. The shares are issued at premium. 6 lakh is par value, 11.5 is premium. This is faltu, not required. Okay, they are saying NCA is valued under PSNA basis. To find out goodwill, we need NCA and all. No? So they've given PSNA basis. That's it. Rest every data is irrelevant. Now, how to proceed it? First, as I told, just make the the shareholding percentage. Before, how was the structure looking like? A was holding 100% in B. Now, what is the structure? A has 75% in C. C has 100% in B, right? But still, ultimate parent is A only. Now, A has 2 subsidiaries. That's all. Okay. All right. Now, if you want, since there is a 2 requirement, now on sale, how much is the gain loss? And then they've asked goodwill computation. So we'll look at the transaction in that particular fashion only. Now, earlier check, sir. A had how much percent in B? Once again, I'll tell you. Earlier, A had how much percent in B? 100%. This is before selling, correct? Now, after the sale transaction took place, how much shares A effectively holds in B? I'll repeat the sentence. After sale, what is the effective shareholding percentage of A in B, right? B ka shares are held by C. What extent? 100%. Does 100% of C belong to A? No, only 75%. So whatever C owns, 75% of that belongs to A. If C owns 100% of B, of that 75% belongs to A only. That means A ka effective shareholding percentage in B will be 100 ka 75%, which is 75%. That's all. So before this transaction, A had 100%. Now after this transaction, they have only 75%. So essentially what has happened, A has sold 25% stake to C. That's all you could say. Because control is not lost. Sir, if it was control was lost, we would have done LOC accounting. If A had lost control over B, we would apply loss of control while accounting. Here control is not lost. Effectively still A has what? 75% in B. Right? So earlier it was 100, now it is 75. So effectively what percentage stake A has sold to C for in B Limited? 25%. Earlier 100, now 75. So effective sale percentage is only 25%. Correct? Okay. So how should we account this, sir? We know this already. Sir, if control is lost, LOC accounting. If control is not lost, then it will be treated as a transaction happening between equity participants. And gain loss, you will book it in other equity. That is what they are asking. Right? Due to this 25% sale, how much gain or loss has A incurred, which has to be transferred to other equity? As simple as that. Okay. What is the entry? Normally, when we sell the stake without losing control, the entry we pass is bank account debit. Okay. Our stake will reduce, but NCA stake will increase. So the entry we used to pass is bank account debit, because when we sell, we'll receive money, to NCI account, because NCI stake will increase. Right? The balancing figure used to be other equity. That's the entry we used to pass. Bank debit, NCI credit, balancing figure, other equity. Here we can't debit bank. Why? Sir, A might have sold 25% effectively. Okay, but did A receive any cash or any money in their bank account as PC? No. What did A receive? A received some stake in C, right? Which is how much? C gave shares worth how much? 17,50,000. She gave shares worth 17,50,000. But hang on. That 17,50,000 is the 100% value of B. 17,50,000 what C gave, right? It is for 100% value of B. But effectively, we have not sold 100% in B. We have sold only 25%. Once again, I'll tell you, what C has given is the shares worth 17,50,000 to A, right? But that 17,50,000 is for the 100%, is a total, that 17.5 lakh is a total fair value of B. It's 100% fair value of B. But we have not sold 100%. Effectively, we have sold only 25%. Hence, what we have to do? Take 17,50,000 and multiply 25%. We will get 4,37,500. Okay. This we are calling it as business purchase of C Limited. Some fancy name we are giving. That's all. Okay. Instead of bank, we are calling this. Then to NCA. NCA is a shareholder. Shareholder will get what? Stake in net assets. Now, which company ka shares did we sell? B ka. Now go back. All right. Now NCA in B Limited will increase, right? Earlier before this transaction, A had 100% in B. So NCA was 0. Now after this transaction, A effectively holds in B only 75%, means NCA will hold 25%. So NCA will get share in their net assets. Which company ka net assets? B ka. That they've given. Check. What is B Limited ka net assets? Net assets prior to disposal is 10 lakh and the goodwill is 6 lakh rupees. Okay, 10 lakh and 6 lakh. A is a shareholder who gets NCA is a shareholder, they get the share in net assets. 10 lakh is a net asset excluding goodwill. So how can you say it is saying excluding goodwill? They have not told, goodwill value they have given separately. When net asset value and goodwill value is given separately, the net assets will exclude the goodwill. So 10 lakh and 6 lakh, total is how much? 16 lakh. So 16 lakh is a net assets of B Limited. NCI will get their stake, which is how much? 25%. How 25%? That is a sale percentage. Because A now has 75% effective stake. So NCI will have 25% stake. So 25% of net assets you have to do over here. Okay. So we should not use fair value. No, here not fair value. Right? Only for your LOC accounting and all, we will have to use the fair value. Or when you get control, business Ind AS 103 says you'll have to take subsidiary ka net assets initially at fair value. That is Ind AS 103 ka requirement. Here we don't use the fair value. Take the carrying amount and multiply by the NCI ka percentage. Right? If this journal entry does not match, then it's a gain or loss. But this is the gain or loss happening between the equity participants. This will not go to SPL. It will be booked in other equity only. So here you are getting balancing figure other equity 37,500. This is the first requirement of the question. Calculate. Okay. That's all it is. Done. So this is the disposal of B part. Okay. Now is that the only part? No. We have got control over C Limited now. Earlier we did not have any stake in C Limited. Now A has 75% stake in C Limited. No. So we got control over C Limited. The moment you get control, you'll have to apply Ind AS 103. In Ind AS 103 says, when you get control, you have to record subsidiary ka net assets, NCI, goodwill, bargain, purchase gain, blah, blah, record PC and all that. So pass that. Okay. What is that? Now let's calculate goodwill if you want. How do you calculate goodwill? First is a PC. PC we already done. How much is it worth? What did C Limited give away? To get basically we got control. We got control over C Limited, right? Okay. Did we pay anything? Did we pay anything to get this control? Yeah, we gave away what? To get control over C Limited, A had to give away B Limited ka. B Limited ka stake they had to give. Worth how much? B Limited ka stake is worth 4,37,500. How 4,37,500, sir? To get, once again I'll repeat this, to get control over C Limited. To get control over C Limited, what A had to sacrifice? To get control over C Limited, A had to sacrifice B Limited ka stake. B Limited ka stake we had to give away. Correct? Fair enough. Because of this only, we received how much from C Limited? 4,37,500. Though we received 17,50,000, that's for 100%. Effectively, we have sold only 25% in B, na? So which is 4,37,500. So same thing will be considered as PC over here. Okay. This is what we have sacrificed. 25% of B Limited worth in a way of sacrificed is what we are trying to say. Okay. 17,50,000 is B Limited ka value. 25% we have sacrificed to get control over C Limited. Right. Hence 17,50,000 ka 25%, which is 4,37,500 is your PC. Then NCI. Right. Okay. NCI will have to value it under PSNA basis given in the question, and you have to reduce the fair value of net assets. This one has to be at fair value because this has to be as per Ind AS 103. Right. So on the date of control, you have to take fair value of net assets. Have they given that? Yeah. Which company ka net assets? The company whom you got control. Whose control did you get? C Limited ka. That fair value are they given? Yeah. The net assets of C Limited ka fair value. Book value may be 380, but fair value is 5 lakh. So net assets of C Limited is 5 lakh. Okay. And NCI is under PSNA basis. So NCI will get proportionate share of net assets. How much is the NCI ka share? A has 75% in C means balance 25% is held by others. A has 75% in C, so balance is held by others. Others only we call it as NCI. So 25% they will get the share in net assets. Net asset is 5 lakh. 5 lakh at 25% is this. That's all. Add this positive number, goodwill, negative number, bargain purchase gain. Here it's a positive number. So it's a case of goodwill on the date of control 60,500. That's all they asked. For which you will have to pass the entry. What entry you will pass? Subsidiary ka net assets debit 5 lakh, goodwill debit 62,500 to what? To NCI to PC, right? Yeah. So that's all you'll have to do here. Now in the solution, what ICAI has done is these two they've asked separately, but the entry they've combined and they've passed. These two journal entry they've combined and they've passed one entry. Now when you do combined entry, what will happen? This 437 debit to 437 credit eliminated. Correct? All right. Then what remains? If you just check net assets debit 5 lakh. That will remain. Goodwill debit 60,500, that will remain. Okay, NCI credit here 4 lakh, NCI credit here 125. Two NCI will come, one for B, one for C, 4 lakh and 1,25,000. Then other equity 37,500. That's it. They have done a compound entry, right, and passed this particular scenario. That's all is this particular question ka main fund. Easy question only, but just need to be careful about the values that you take. That's all. Carrying amount, fair value, 100%, 75%, 25%. So the game is only around this. So once review this question, okay, if required, once practice this question so that the numbers, the calculation part gets stuck in your head. Okay, but this is a good question, right? But they've just given dump of data. All this is not required, right? Because we are not preparing CFS. They only asked 2 transactions. For this much is good enough, right? So yeah, that was this particular question ka drama. Hope it's fine with you. All right, question number 13, 14 are repetitive questions, so let's not waste time there. In 14th question, it's a similar question, but they've just added one adjustment. It's a biological assets ka question. Now, when you buy a biological assets, they also told we have incurred 500 as veterinary expenditure. So we took that goat or cow or whatever to our veterinary doctor and we incurred some veterinary expense of 500. Right? This is what you have to do when they've asked the journal entry for this. All this transaction. This will be expensed off. Okay, SPL account debit to bank. Basically expenditure. Right? Okay, that's all you'll have to do. Rest everything is same as the class question, no change. Okay, this is one. Next question they're saying is on Ind AS 28. I'll keep this question also as a LDR, a good question, easy only, but yeah, good. Let's review and see what we can learn from this particular question. Excuse me. Okay, Beta Limited investee, they've issued 2000 investee, basically keep that in mind. Okay, not investor, investee. They've issued 2000 equity shares which are outstanding on the reporting date. They already have 2000 equity shares. On this day, Beta issues, same company, on the same day, that is last day on the reporting date, they issue 1000 share option to employees which can be converted into 1000 equity shares of Beta. So some shares are given to the employee which will get converted into 1000 shares. They already have 2000. Now they've issued 1000 shares more. Fine. The grant date fair value is 1. Since it's a equity settled option, because we're giving shares to the employee, it's an equity settled option. For equity settled option, as per Ind AS 102, we take grant date ka fair value and do the accounting. Subsequent changes to fair value we ignore in case of equity settled plan. So grant date fair value one option is 1 rupee. Option will vest over 5 years. That is a vesting period. All 1000 options are expected to vest. Nothing will get lapsed. Fine. This is one part. Beta recognizes share-based remuneration expense. I'll read this. You may not understand this fully. We'll see. Okay. So how is it associated, sir? We will see. Okay. Now check. Excuse me. Beta Limited recognizes share-based remuneration expense of 200. How? Sir, when you issue equity settled plan, what is the journal entry? Employee benefit expenses account debit to SBPR. Right now, we have issued 1000 shares and each ka fair value is 1 rupee. So the total fair value is 1000 rupees, right? And there's no change in any estimate. So you don't have to put, we used to put working note number 1 to calculate each year ka employee benefit expenditure. That is not required here because very straightforward. 1000 shares, each ka fair value on the grant date 1 rupee. So total fair value of the option is 1000 rupees. That will be booked over 5 years. 1000 rupees if you book over 5 years, every year you will book what? 1000 divided by 5, 200. So that is what this company is doing. They pass the journal entry, employee benefit expense to SBPR 200 for 5 years. Okay. Current year they have passed. Since we are not talking about all the 5 years, we are talking about the current year. Fine, fair enough. One investor is there called Alpha. They were holding 600 shares of Beta Limited. Okay. Now that's where associate comes into picture. How? Sir, this company totally has 2000 shares and as an investor, we are owning 600. Of 2000, we are owning 600 means the shareholding percentage will be 600 by 2000, which is 30%. With 30%, you get SI, no, significant influence. So this Beta Limited becomes what? Associate. So the investor is Alpha, Beta Limited becomes associate company. Okay. Alpha has significant influence, they only told. Okay. Alpha recognizes its share of remuneration expense in P&L as part of income from equity accounted investees. It records offsetting credit as reduction of investment. I'll tell you what this is. We know this, but they're trying to express in fancy terms. Okay, no problem. So far we understood that it's an associate company. Fair enough. All right. Now, what is the requirement of the question? At the end of the vesting period, that is 5 years, all the options vest and the exercise price is 3 rupees per option. Fair value of the option is 1 rupee. First requirement of the question is, in the books of Beta Limited, the associate company, and Alpha Limited, you need to pass the journal entry for first year is what they've asked. Okay. All right, both the company ka. Now let's pass for the first one. What is this? I've just put up calculation for your reference. Now first, the company is issuing the shares to the employee. How many shares are they issuing? 1000, right? And the fair value of one option, fair value in the grant date of one option is 1 rupee. So the total fair value of the option is 1000. This will be recognized over vesting period of 5 years. So employee benefit expense every year is 200. So the entry will be employee benefit expense to SBPR from year 1 to year 5. They have not asked for all the 5 years, just for our reference. This will do, correct? First entry in Beta Limited. Then on the vesting period, they're saying option got exercised. So 5th year is the vesting date. What entry will pass? Once it gets vested, is the company giving the shares at free of cost? No. The shares, the employees to buy the share have to pay the company 3 rupees per option. So the company will receive, the company will pay, the employees will pay the company 3 rupees per option. So the journal entry will be bank account debit. How many options? 1000 shares. Each ka exercise price is 3. So bank account debit 3000 rupees. This is one. Now we don't need SBPR anymore because the shares are issued. It has got vested. Once the shares are vested from SBPR, it will be transferred off to equity share capital. So SBPR, which is credited, will be debited. So 200, 200 is for 1 year, macha, right? 200 every year, and we have to account this for 5 years. So the total balance in SBPR will be 1000. That is 200 for 1 year, for 5 years 1000. Okay, to equity share capital to security premium. How many shares? 1000. Each ka fair, I'm taking the fair value and the face value to be same. So to equity share capital 1000, balance will be transferred off to security premium. This is what the journal entry associate company will pass with respect to their employee benefit expenditure, basically equity settled plan accounted as per Ind AS 102. Pretty straightforward, nothing new in this, correct? We have done enough number of such questions. That is sorted. Now what they're asking is, they're also asking the journal entry in the books of Alpha for this. What Alpha should do? Sir, when it's an associate, we follow equity method. Right? I told you a simple thumb rule of equity method. What is that? Right? Initially, you will show the investment at cost price. Right? Thereafter, you match investment ka value with associate ka performance. Investment ka value will be matched with associate company ka performance. If associate company reports profit, we will have a happy face. Our investment balance will increase. If associate company reports a loss, our investment balance will reduce. No. The associate company has booked an expense of 200 in the first year relating to employee benefit expenditure. Relating to this ESOP, associate company has booked an expenditure of 200 in their books. When you account an expenditure, obviously expenditure will increase. An increase in expenditure will lead to what? Decrease in profit, right? Or rather it will increase the loss, you could say. Yes or no? Due to expense, loss will increase, right? Or profit will reduce. Okay. So that means for investor, this is happy news or sad news on. Due to this expenditure, associate company ka profit is reducing. If associate company ka profit reduces, means associate company ka net asset also will reduce. Because how do you calculate net assets? Equity plus other equity, right? So due to this expenditure, if P&L balance is reducing, means other equity will reduce. If other equity reduces, means net asset also reduces. If net asset reduces, for us as an investor, it's a loss that we have to account. But will we record full loss? No. 200 is a total expenditure. But we don't own 100% in that company. As a shareholder Alpha, we own only 30% now. Out of 2000 shares, we own only 600. So our stake is only 30%. So our share will have to record. 200 ka 30%. How much is that? 60 rupees. Yes. What is the entry for this? That's what we're calling it as loss, share in loss of our associate company called Beta. Or you can write P&L. This will anyway go to P&L. SPL account debit to investment, 60 rupees. This is in first year. Same entry, the investor has to pass for 5 years. Because this expenditure 200 is for 1 year, no? The same expenditure associate company will account for 5 years, means this same entry investor also will have to account for 5 years. This they did not ask, they only asked for first year, but I have written for your reference from year 1 to year 5, this entry will be passed. Okay, G. This is the requirement. So this we have done, this we have done. Okay, exercising journal entry also we have already passed. Bank account debit, SBPR account debit to equity share capital to security premium. There's an exercise entry that is also accounted. So these two requirements are done. Now the last requirement, in the books of Alpha, the investor, compute the loss on dilution of shares of Beta Limited and pass the journal entry for the same. Beta ka net assets total 11,000 immediately before the shares are issued. Sir, what are they talking about? Sir, till the last date, okay, till the last date, associate company had how many shares? 2,000 shares. And in this 2,000, we had 600 shares. We as an investor had 600. So our shareholding percentage was 30%. Now, this associate company, they have issued some shares to their employee. Some additional shares the company wants to give it to their employee. Okay. Now, due to this particular drama, they are asking whether our investment in associate balance will reduce or not. That only they're calling it as loss due to dilution. First of all, is stake diluted? Check. Yeah, of course it is diluted. How? Sir, once the shares get vested, now what will happen? Now we as an investor have only 2,000 shares. But the associate company will not, we as an investor have only 600 shares. But the associate company will not have 2,000 shares. They will have 2,000 plus 1,000 new shares given to their employee. So the total number of shares, the denominator will be 3,000. In that, we will only have 600. Because this 1,000 shares are issued to the employees. So investor will not get this. Investor ka number of shares is still 600. Out of 3,000, investor owns 600 means now the revised shareholding percentage will be 20. Okay, 20%, right? Earlier we had how much? 30%. So due to this option, we do have a diminution or dilution in our stake from 30. That only we're calling it as loss due to dilution. From 30, it has become 20. Due to 30% becoming 20%, how much is the loss we are suffering is what they are asking us to calculate. Okay, just we need to calculate the value of investment. How? Simple. What is this associate company ka net assets before the shares are issued? 11,000. Okay, Naji? Alright, excuse me. And before this 11,000 is before this employee share issue option, right? And before this shares are issued to employee, how much stake we had? 30%. That means what is our stake? Because whenever you buy equity shares of a company, you get that company ka share in net assets. Before shares are issued to the employee, net assets was 11,000 and our stake in associate company before was 30%. That means the value of our investment is how much? 3,300. Correct? Right? Okay. Now, associate company has already given the stake, right? Or has already issued the stakes to the employees, right? And how much is the loss they are suffering due to this? How much expense they are booking every year due to this particular, excuse me. Now, this is one. Right? So how much you can calculate this in multiple way. Okay. So how much was the net assets, or you can calculate in one line or also like this or through like this. Now, how much was the associate company ka net asset before this transaction? 11,000. Due to this transaction, how much expense associate company will book? 200 every year. For how many years? 5 years. So total is how much? 1,000. That means if an expenditure increases, P&L balance reduces. So other equity reduces. If other equity reduces, net asset also will reduce. So net assets from 11,000, it will become 10,000. And we have how much stake? 30% stake. That means the value of our investment should have been how much? 3,000 rupees. Like that. Okay. You can calculate net asset separately, share in expense separately, or you can directly do it like this also. One and the same. Whichever way you want to represent, it's okay. So ideally, our investment value should have been 3,000. Ideally, our investment value should be 3,000. But is it 3,000? No, it is not 3,000. Why? We don't have 30% anymore now. We don't have 30%. We have only 20% stake. After the shares are issued to the employee, now we as an investor, we don't own 30%. We have only 20%. So basically, that's what they're asking. Basically, you have to find what was the value of the investment before and after. Okay, that's all. That's all we're calling it as loss due to diminution or dilution. So our value of the investment should have been 3,000. But is it 3,000? No. How? Now calculate what is the current value of our investment. Okay, currently how much net assets subsidiary company has? Currently, how much net assets company has? Associate company has 11,000. Okay. Now 1,000 reduced due to this expenditure. Correct? No, 1,000 expenditure reduced, right? But also, or maybe directly we will do it here like this. We will do. I think much better. Look at this entry of this effect. You just have to give this entry ka effect. How? Simple. When shares get exercised, what happened? Check here. Equity share capital increase. This is of associate company. Associate company ka share capital increased by 1,000. Security premium increased by 3,000. So this is equity and this is other equity component. So due to this transaction, equity and other equity increased by how much? 4,000. Correct? Sir, if equity and other equity increases means net asset also will increase. If net asset increases means we will get a share in that. Okay, that's what we have to compute. But do not forget, SBPR also you debited. SBPR is also a reserve, right? SBPR also will form part of other equity. So your debiting means then other equity will reduce by 1,000. So net mein what is the effect? Due to this transaction, equity and other equity is increasing by 4. Due to this, it is reducing by 1. So net effect is due to this particular transaction, net assets of associate company has increased by 3,000. Net asset of associate company is increased by 3,000. How much was net asset of associate company before this transaction? 11,000. Before this transaction, it was 11. Due to this transaction, net asset has increased by 3,000. Okay, this is one way to calculate it. This is working from equity and other equity side. Or you can also find out net assets using the normal way, assets minus liability also, right? You can ignore this and only consider asset liability. Due to this transaction, bank balance increased by 3,000. If bank balance increases means asset balance will increase by 3,000. If total asset increases by 3,000 means net asset also will increase by 3,000. Like that also you can do. You can give this effect in net asset or only this. For all our consolidation problem, we used to do like this. Hence, I thought I'll explain that fashion. Okay. So net asset before this transaction was 11,000. Due to this transaction, net asset has increased by 3,000. So total net asset of associate company now is 14,000. It is 14,000. And we will get entire 14,000. No, we as an investor don't own 100%. We own only 20% after transaction. After transaction, our stake is only 20%. So out of 14,000, our stake is 20%. So the value will be 2,800. It should have been 3, but it is 2,800. So that 200 value, what investment reduction has happened, that only we're calling it as loss due to dilution. Okay, people, it is reduced. So obviously, what you have to do? Investment balance you have to reduce. Credit it, debit will go off to SPL. So loss on dilution, SPL account debit 200 to investment in alpha or investment in associate 200. This is the entry. That's what they've asked. That's all it is. Okay, now people, basically, yeah, this is the effect you need to just skip back. Before and after you need to compare, and it is that the difference could be your gain or loss transferred to SPL. Okay, all right. This is a question. I'll just show you once, just in case you're updating anything or want to review something there. Okay, people, I think you're good. So let's go for this is done. As I told, this question is an LDR. Simple only, but again, review it once if you're able to understand it. If you're getting stuck somewhere, ideally practice it once. Much better that way. Okay, because once you put it across, when you start writing and when you start solving, the retention will happen for a longer duration. So ideally, so if the flow is pretty smooth, if you're not getting stuck, if you're able to recall everything, then it's fine. You can just review these questions on your calculator. 5 minutes. If you're getting stuck, I would suggest solve it once, or maybe first review it once and then try to solve it once quickly, so that you're pretty much set in this particular question or these sort of questions. Okay, so this is done. This is 15 too. So moving along, we'll go ahead with the next question. Question number 16. Again, LDR, India is 109 ka question. One company ZX, they've issues fixed rate loan for 5 lakh. They've taken a loan or debentures, you could say, right? Worth how much? 5 lakh. Incurs issue cost of 20,000. That's only we call it as transaction cost. So issuing loan is a financial liability, right? You can take it as a loan taken, or you can simply call it as debentures or bond issued also. It's fine. It is worth how much? 5 lakh. Transaction cost is 20,000. We already know. If it's a financial asset, transaction cost we add. If it's a financial liability, transaction cost we reduce. So that means the net price will be 5 lakh minus 20, which is 4 lakh 80,000. Okay, they're only given, resulting in carrying amount of 480. Basically 5 lakh minus 20, which is 480. The actual interest rate given is 8%. Fine. All right, because there is a transaction cost now. So actual rate and EIR will not be same. Okay, so they would have given EIR because there is transaction cost, right? Okay, the loan is repayable at par at the end of third year. So 10 years is the total duration of this particular loan. However, under the contract, Z can call the loan at any time after year 4 by paying a fixed premium of 30,000. The normal duration, the duration mentioned in the agreement is 10 years. Okay, the loan duration is 10 years. But if the company wants, they can repay this loan any time after year 4. For the first 4 years, they can't. Anytime after year 4, company can repay on their own. So they don't have to wait till 10 years. They can repay by 10 years only. Fine. But if you want to repay, right, you can't pay 5 lakh. You have to pay 5 lakh plus 30,000. You have to pay a 30,000 premium. Because originally the investor who has purchased this debentures, no, they would have thought the term is 10 years. Now, if you cancel by 4th year only or 5th year only, they are losing few years ka interest, right? So probably it's agreed that we don't redeem it at 5 lakh. We have to pay a premium of 30,000. Okay. The fair value of this option is 10,000 rupees. This callback, right? We are calling back our instrument. So this call option, right, has a premium of 10,000 at inception, right? Derivative instruments are basically usually derivative instrument ka on the contract date, inception date, they'll not have any fair value. So we will not pass any entry. Here they only given this call option ka fair value is 10,000 at inception. Not after 4 years. Now only its fair value is 10,000. Effective interest rate is 8.30 something because we have transaction cost. No, so the actual interest rate and EIR will not be same. They have given this because we need EIR to book our finance charges, right? So given how this embedded issuer only call free option should be accounted. Sir, embedded derivative, sir, how? Sir, if you remember, we had discussed one example in our regular class about this prepayment option. If you have any prepayment option, the prepayment is a feature of an embedded derivative. Embedded derivative means what? It is not a derivative. Okay, the contract is not a full-fledged derivative, but it has some features of derivative. Some derivative features has been included in the contract. Hence, we call the name as embedded derivative. Okay, we are giving you some rules over here. We'll have two things: host to embedded derivative and all, right? So, some cases may host and embedded derivative will account it as one. We will not separate them. In certain case, we will separate. I had given you some diagram also for that, if you remember. Right? Here I told you, actually, like in one example, we had done. If, anyway, it's a financial liability, right? So, you will prepare ACM table. If that ACM table ka closing balance, and if this price, at what price are you redeeming this particular option? 5 lakh plus 30,000 premium, which is 530, right? If that ACM table ka, every year ka ACM table closing balance, if it approximates to the repayment price, then we can say it's closely related and don't have to separate it, right? We'll have to basically calculate the percentage. That's what I told. And management discretion will come into picture over here. When you calculate the percentage, you may get 1%, 10%, 5%, whatever. Now, management has to take a call. What is significant for them? If the difference is significant, suppose management tells, we compare this price, this call option price with ACM table ka price will compare. If that percentage, the differential percentage, if it is more than 3%, management feels it is significant, right? They've taken a call that 3% is significant for them. In that case, what we have to do? Now calculate this percentage. If it crosses 3%, then we say it is significant, then we need to separate. If it is within 3%, no need to separate. That's what I told you theoretically in one of the example. Here, management judgment will come into picture. But here, if you read the question, nowhere they have told whether this host is your financial liability here, right? And we have an embedded derivative over here. Whether this host and embedded derivative, are they related or not related? Not mentioned. They have not given any information regarding that. Now, what ICAI has assumed this is host and embedded derivative are not closely related. They have assumed that it is not closely related and they have segregated this. That's what we'll have to keep in mind. I hope, sir, one kind request, sir, watch all this RTP, MTP videos and all after you're done with your preparations, right? Because all this we have covered in our regular class. We have done many questions. Now we are quickly reviewing these questions for the new elements, right? So I'll have to by default go a little faster. If you have not watched those regular videos, first watch them and then come back, because there we have solved many questions with the pointers. So it'll be easy for you to connect back. Okay. Or if you have done and if you have forgotten, that's okay. You can try to manage with this recording. In case you're not able to recollect, you can open your notes and refer back those questions or watch that video and come back to this. Okay, whichever it is, right? But yes, you should be comfortable with these sort of concepts before you start watching this RTP sessions and all. Okay, because we'll not have time to again give you a full recap of that. Okay, if you want, just quickly for 1 minute, I'll tell you what is embedded derivative here is. Now people, excuse me. Now this particular, there is a prepayment option here. Do you agree with me? Yeah. Why? So the loan ka original duration is 10 years, but if company wants, they can repay within 4 years, right? Now, if you are finance manager of this company, if you are a finance manager of this company, will you repay this loan? Will you early repay this loan? Will you repay this loan before 10 years? Yes, you might. When? Suppose, sir, suppose in 5th year, market interest rate has become 5%, assumption, right? The market interest rate has become 5%, meaning the company can issue new debentures or the company can take a new loan by paying how much interest? 5%. But on their existing loan, how much interest are they paying? 8%. Now, what will the finance manager will use? Kidney now, right? Existing loan or debenture, they are paying 8%. Now, if they cancel this old debenture or loan, they can take a new loan and pay only just how much? 5% interest rate, right? So, yes, this is the feature of this. Hence, we say prepayment option as embedded derivative. What is that embedded derivative? Sir, whether the company will prepay or not is dependent on market rate. Whether the company will prepay or not is mostly influenced by the market rate. If there is a fall in the market interest rate, then company, in most probabilities, there is a high probability that the company will prepay this, right? And the market rate is not fixed. It will keep fluctuating, no? So hence we say this prepayment option has some derivative feature. That only we're calling it as embedded derivative. And here the conclusion is, since they have not given anything, ICAI assumption is this host, that is financial liability, and embedded derivative are not closely related. So we'll have to do separate accounting. For this host, that is financial liability, you'll have to do ACM accounting. For embedded derivative, we follow FVTPL accounting we'll have to do. That's what they're asking. Okay, now. So you need to give the accounting for year 1 and year 2. There is no change. So first we will do inception accounting and then we will talk about year 1 and year 2. So what is the entry you'll pass now? How much money company issued? Company took a loan for 5 lakh and there is a transaction cost of 20. So bank account debit 4 lakh 80,000. 1 second. Bank account debit 4 lakh 80,000. This is the day 1 or year 1 beginning. We'll pass the entry. Bank account debit 480. That's it. No, since host and embedded derivative are not closely related, we need to separate, right? That call option, right? How much is that fair value of that call option? The fair value of that call option is 10,000. That is your embedded derivative. Right? Excuse me on that. So you will pass embedded derivative asset account debit. You are paying for it, no? Right? You are paying a premium. Whenever you pay the premium, right? Or you call it as embedded derivative asset. Okay? How much value? 10,000 rupees. And credit will be given to, you have issued the debentures, right? Or a loan. So it's a financial liability. To financial liability 4,90,000. This is the entry you will pass on the as initial recognition. This is your host. This is your embedded derivative. Right? This host going forward will get accounted using ACM method. This embedded derivative going forward will be accounted using FVTPL method. This is not an actual derivative, right? But we are, for the sake of accounting, we are treating in substance as a derivative and doing the accounting. Later on also I told you how to cancel it. At the end, when the prepayment happens, like since there is no derivative over here, all these are simply notional, this embedded derivative gets adjusted with the host. If you remember our class note points, you'll know this. Embedded derivative at the end will get adjusted through the host itself. We create with the help of host. At the end we reverse also with the help of host only. Host here refers to financial liability. So this is the entry. Bank account debit, embedded derivative asset account debit to financial liability. Now onwards, very straightforward. If you want, I'll read the question one. So first year, second year they've given, third year they've given. What happened to the fourth year? Check. If you read the question, there's one more. At the end of fourth year, the fair value is 20,000 and entity decided to repay the loan. Fourth year, they have exercised prepayment option. That's what they're saying in the question. So since the loan is getting repaid in fourth year only, we will not put up ACM table for 10 years. We will put only for 4 years. Anyway, it is getting repaid. Na? So ACM table you put. Opening balance of financial liability is 490. All right. And then finance charges at effective interest rate, which is 8.3021%. Take that. And payment will be what? Payment will be the actual interest paid. Principal you will repay at fourth year only, right? So now interest you have to pay every year, and actual interest rate you are paying is 8%. and interest is calculated on the face value, which is 5 lakh. 5 lakh ka 8% is 40,000. That is the interest you will pay for all year. These two addition minus this will give you closing balance, a normal ACM table. So this is the balance of financial liability at the end of 4th year. Okay, G. For which I've given you the journal entry. The entry you will pass is finance charges account debit to financial liability to buy. All this they have not asked, just for your reference. This entry you have to pass for like 4 years. But hang on. Each year they have given some, I think they have asked for accounting for year 1 and year 2. So we need to pass it. Okay. Now let's go back. Initial recognition we have done. Then ACM table we have put forth. Now for derivative, what do you do? At every reporting period, derivative should be measured at fair value, right? And the fair value gain loss we accounted through SPL. Okay. Here we'll see. In first year, so keep it in mind, initially our derivative is shown at what values? 10,000, because they only told the fair value of that derivative, that is option, is 10,000. So currently in our books, derivative is reflected at 10,000. When this 10,000 is a value at year 1 ka beginning. Okay. Now at the end of year 1, fair value can change. Have they given? Yeah, check. It was 10,000. In first year, second year, there is no change in the interest rate since the inception of instrument. Okay. The options fair value at the end of year 2 is 6,000. First year end, there is no change in option ka fair value. So it was accounted initially at 10. If there is no fair value increase or fair value reduce, we don't have to do any accounting. It remains the same. So at the end of first year, derivative financial asset ka balance will be 10,000 only. But second year, however, from 10,000 fair value has become 6,000. From 10, it has become 6. So it's a fair value decrease. So what do? You have to reduce the value of the asset, right? So FVTPL method. So this loss will be accounted through SPL. So the entry will be second year you will pass SPL account debit to embedded derivative asset. Okay, basically you were showing it at 6, but now you were showing it at 10. From 10, you'll have to bring it down to 6. So the reduction is 4,000 accounted through SPL. First year, since there was no change, this entry will not come in the first year. It will come only in the second year. Okay. Now what happened to third year? Third year, interest rate have fallen and option ka fair value increases to 9. Now it has become 9. So till second year, it was 6. Now from 6, it has become 9. From 10, it became 6. We did that. That part is already taken care. Now from 6, it has become 9. So what? It's a fair value increase by how much? 3,000. So what entry we need to pass? Embedded derivative asset. You have to increase. No? Asset, if you have to increase, means you will debit again. Embedded EDA as in embedded derivative asset account debit to SPL 3,000. Okay. This entry is your normal ACM table ka entry. Third year ka finance charges and third year ka payment. That I've just copy pasted. Okay, G. Now fourth year. Fourth year, what happened? Fourth year, now 1 second. At the end of third year, embedded derivative asset ka value is 9. At the end of third year, embedded derivative asset ka fair value is 9. Fourth year, what happened? Fourth year, no, interest rates have fallen and fair value increases to 20. From 9, it has become 20. So there is an increase. How much? 9,000 has become 20,000 means the increase is 11,000, right? So first account it, 11,000. So you'll have to increase it. So embedded derivative asset account debit to SPL 11,000. Pass that. Passed. Here done. So this is for fourth year you will pass. Now at the end of fourth year, what we'll have to do? Company has chosen to prepay. Since interest rate there is a big fall, company feels it's better to repay this debenture and issue a new loan or new debenture at a lesser interest rate. So they went for this prepayment option. Now you have shown derivative all this while. Is this an actual derivative? No, this is just for the sake of accounting, right? So this we'll have to reverse. How much is the EDA embedded derivative balance now? It is 20,000. By passing all this journal entry, it is 20,000. If you want, you can cross check also. Here you're debited by 10. Here you credited by 4. 10 minus 4 is 6, right? Okay. 6 plus you debited here by 3. So 6 plus 3 is 9. 9 and here you're debited by 11. 11 plus 9 is 20. Or anyway, embedded derivative, we follow fair value accounting, right? At the end of fourth year, the fair value is 20 means the embedded derivative in our books will be 20,000. Should we show that anymore? No, since the loan is not there, this derivative which is part of this loan also will have to cancel there. Okay. So you'll have to credit embedded derivative for 20,000 because its value is 20,000. What happened to financial liability? You're repaying. So financial liability ka fourth year balance is what? 493,080 as per ACM table. So debit that, right? To bank account. You have to pay now. And there's a clear instruction that whenever you want to repay, you have to pay a premium of 30,000. You can't pay 5 lakh, you have to pay 30,000 extra. So the payment will be 5 lakh plus 30,000, which is 5 lakh 30,000. Okay, Ji. The balancing figure is a gain or loss to be transferred off to SPL. Now you are derecognizing financial liability and embedded derivative, no? Right? So that gain loss you will transfer it to SPL. That is one. You can pass compound journal entry like this, or you can split like the way we used to do it in class, right? When the due date comes, since this embedded derivative is notional, we adjust it or we cancel it with the help of host. This embedded derivative will cancel with the help of host. Embedded derivative has debit balance. How do you cancel it? Credit it. And it will be adjusted with a host. Host here is financial liability. So EDA credit to financial liability debit 20,000. This is adjusting through loss. Like this we have done in class. Right? And now what will be the FL balance? After you pass this journal entry, FL balance will not be 493. From 493, its balance will reduce by 20 and it will become 473. And what did you do for this financial liability? To repay it. So FL debit this much to bank 530 and balancing figure is derecognition gain or loss on financial liability transferred to SPL. Either you can pass these to separate journal entry, right? Or you can combine them and pass one journal entry. I think ICAI has done this particular entry in their solution. That's all. Easy only, right? The only thing is you need to be a little more careful about embedded derivative. And if such question comes in exam, assume that host and embedded derivative are not closely related, because we check the parameter and conclude there's a management judgment here involved. If they don't give any information, since ICAI assumed that it is not closely related, you also make the same assumption for examination if it turns up again in your attempt, right? Yeah, this question is also done. Good question. Easy only, but yeah, good one. Okay, so this is sorted. Next, what is there? 17th, 18th are repetitive questions, not really required. We have a similar question in our class itself. We have it. Okay, 19th and 20th both are LDR. Let's review the 19th one first. Easy only again, but yeah, still we will review. Now there's a question on leases. Wealth Limited, one company, they've entered into a lease with a lessor for 5 years. Okay. Annual lease rental is 8 lakh. There is an option at the end of set period that the lease can be owned by the lessee. There's an option to purchase. The lease can be owned by the lessee means lessee has an option to purchase the asset at the end of lease term. Other factors are noted are discount rate is 8%. Interest rate implicit in the lease is 10%. So usually in all our lease problems, we don't see multiple rates, right? They usually give only one rate. I told you the first priority for is always IRR. If IRR is not there, we take incremental borrowing rate of the lessee, right? So here one rate is given as 8% and they also told IRR is 10%. For our lease problem, IRR is always the first preference. So we will take 10% and as a discount factor for all our calculation. This 8% is not a relevant number for us. Okay. Now, when is reasonably certain to exercise the option to purchase the asset, and 56 lakh is the exercise price agreed at the end of the land at the end of 5th year. Now exercise option is there. Now asset lessee has an option to purchase, not at free of cost, but by paying 56 lakh. And lessee is reasonably sure that they will buy it because they see value in this. So what we have to do? If lessee is reasonably certain to exercise the purchase option, and purchase price also will form part of lease payment. We have discussed all this, right? Lease payment, there are various breakup. This also is part of lease payment, provided lessee is reasonably certain to purchase it. And in this case, yes, lessee is reasonably sure that they will purchase it. So this also will form part of lease liability, or this will form part of lease payment. So you'll have to consider this for lease liability calculations. Okay, so therefore same has been considered in computing present value of lease liability. They are telling the steps that we know. At the end of year 3, Wealth exercised the option to purchase the land of 50 lakh, whereas the market value was 75 lakh. Hang on. So the lease was 5 years, right? So ideally, lessee had an option to purchase the asset for 5th year, right? But what happened here? By 3rd year only, lessee purchased of the asset. Okay. So in a way, the lease has come to an end now, because after you purchase the asset, why will you pay lease rental? Correct? No. So, sir, why will the lessor agree? Sir, they have said that purchase has happened means lessor and lessee have agreed for it, right? So we can't do anything about it. Ideally, this purchase should have happened at the end of 5th year, but here at the end of 3rd year only it has happened at 56 lakh. So that's what we'll have to do over here. So there's some changes which has happened here. Okay, for the revised discount rate, consider IRR itself. The new rate also they're saying is 10% only. Now they're saying calculate lease liability and ROU, and ROU is depreciated on straight line basis, it seems. Provide the amount reflected in balance sheet, P&L and cash flow for 1st year. due to this transaction, your balance sheet, SPL and cash flow statement, how it gets affected for first year, we need to show its effect. What are the accounting entries if wealth decides to purchase this property at the end of third year? Okay, so those are calculation. Very straightforward calculation. Now, first, initially for ROU, there is no measurement basis. How do you measure lease liability? Initially, lease liability is measured at present value of future cash flows, right? So, what are the two future cash flows that lessee will have to incur? One is the lease rental every year for 8 lakh. Another one is 56 lakh payment at the end of 5th year. See, actual purchases happened in 3rd year, but initially when the contract was entered, initially when the lease contract was entered, the option to purchase this asset was not for 3rd year. It was in the 5th year, right? So initially when we are doing the accounting, what will be the thought process? 5 years we have to pay lease rental of 8 lakh. 5th year we will pay 56 lakh and we'll buy off the asset. That was the thought process. That changed later on. When it changes, what to do, we'll see it later. First, we will do the initial part. So 8 lakh is coming every year. So instead of calculating each year ka discount factor, we'll take annuity factor. Okay, at IRR. IRR rate is, as we have discussed here, 10%. At 10% PVAF you need to find for 5 years. That is this. And 56 lakh will only come once. So we use same 10% ka 5th year ka PVIF, which is this. So this will be the initial measurement of ROU and lease liability. We'll pass the entry ROU account debit to lease liability, this particular value. Okay. Now ROU will have to depreciate, right? Okay, ROU initially again lessee ka thought process is we'll use it for 5 years. So you'll depreciate over 5 years. Correct, no? Right? So if lessee has an option to purchase it, will we not depreciate the asset over its useful life? Yeah, but they have not given the useful life of the asset, no? Correct? So we will depreciate it over the lease term only. Okay? Lease term is how much? 5 years. So this is ROU ka initial value or year 1 beginning balance. This is the depreciation for first year. This value will be depreciated over 5 years. So the depreciation every year will be 13,01,920. After depreciation, this will be ROU balance for first year, right? Similarly, I found out ROU balance for 3 years. Why 3 years? After 3 years, thought process changed. No, we did not wait till year 5 to purchase the asset. We purchased the asset by the end of 3rd year only. So hence ROU balance I found out at the end of 3rd year, which is this. Basically 3 years ka depre we have reduced. From this value, if you reduce 3 year ka depre, you will get that much. That is one. Now what about lease liability ka value? For lease liability, you'll have to put up an ACM table, which we have put up here. Not for 5 years because anyway 3rd year only we're purchasing. So put a lease liability ACM table for 3 years. Opening balance is 65,960. Finance charges at EIR of 10%. Payment. Every year you have to make a payment of 8 lakh, which is captured here. Closing balance. These two ka addition minus this will give you closing balance. First year closing will become next year ka opening. Like that, do it. So lease liability balance in our books is 60,16,278. Okay. Now what happened? Now people, instead of buying the asset in 5th year, now we are buying the asset in 3rd year only. So it's a remeasurement basically, right? It's a new remeasurement concept. Now we know this. Whenever remeasurement concept, what happened? We have to find the revised lease liability. How? Present value of future cash flows discounted at new rate. And here they're saying the new rate is also same, old IRR only, which is 10%. Okay. But people, to find, since there is the remeasurement here, there's a remeasurement of what? Initially we thought we'll purchase the asset for 5th year. Now we are buying it in 3rd year only. So that is getting remeasured. Okay. All right. That's what we said. No, whenever this remeasurement concept, we used to say in class RRSGV. Remember? So this is probably one of the R, right? So yeah, we'll have to use the, we'll have to use for the 2 R's, we'll have to use the new rate. For the SGV, I told you, use the old rate, correct? If you remember the chart, for easy remembrance sake, we had written this. Okay, now we'll have to remeasure the new lease liability. How to find? The new lease liability ka remeasurement is present value of future cash flows discounted at new rate, right? But the problem here is when you purchase the asset, will there be any future cash flows? No, when you purchase, future cash flows is what? Lease rental. When you're buying the asset today only, you are in 3rd year now. 3rd year ending you are currently. On 3rd year ending only, if you are purchasing the asset, will you make any lease rental in future? No. So there is no future cash flows. There will be only one cash flow. What is that? Now you have to pay simply 56 lakh rupees and buy the asset. Okay. That means what? 56 lakh rupees you have to pay. Only one cash flow is there, which is 56 lakh. When you'll have to pay? third year ending. Currently, which year are you standing on? Third year ending. I mean, the 56 lakh itself becomes new lease liability ka balance because it's already on present value terms. Currently, we are in third year ending. This payment also we will make at the end of third year. So the new lease liability balance will become 56 lakh. That is a payment, purchase price basically, because that is the only cash flow available and it is not being done in future. It is done immediately. Hence, this will be the balance. Okay. But currently our lease liability balance is 60. Required new one is 56. Currently it is 56, right? So lease liability you have to reduce, and we already studied remeasurement gain loss. You will not transfer it to SPL. Any remeasurement gain or loss we adjusted in ROU itself. We have studied this and done many questions on this. So from 60 if you have to make it to 56, lease liability you have to reduce by 4,16,278. What entry you will pass for this? Lease liability you'll have to reduce and it is adjusted through ROU. So entry will be lease liability account debit to ROU, this particular entry. Okay. Once you pass this entry, lease liability and ROU, both balance will reduce by this particular amount. So revised ROU balance will be, it was after depreciation 26,03,840. Now due to this remeasurement gain or due remeasurement loss, it is reduced by 460 and the revised ROU balance will be this. And revised LL balance also will be 56 lakh. Okay, na? Fine. Now last entries. The usual entries are pretty much same. You know, no? First May you will pass the entry ROU account debit to lease liability. Then for 3 years you need to book finance charges. Entry is finance charges to lease liability. Then when you make a lease rental payment, lease liability to bank entry you will pass. ROU should be depreciated. This finance charges, this depreciation, both will be transferred off to SPL. That you'll have to pass for 3 years. Basic entry, I've just written the sample, I've not done the amount. Okay. Third year ending May, when you purchase the asset, one, you'll have to book a remeasurement gain wala entry. A liability is getting reduced, no? So it's a remeasurement gain entry. That entry is lease liability to ROU. One is that. Then, now, is it a lease liability anymore? No, the lease has come to an end because we purchased the asset. So what? You'll have to make a payment of 56 lakh and shut down. So when you make the payment of 56 lakh, the entry will be lease liability to bank 56 lakh. Once you pass these two entries, lease liability balance will become 0. It's nullified. Okay. But we still have ROU. How much is the ROU balance? It was 26. After you book remeasurement gain, it reduced by 416. So ROU balance now is 21,87,562. Right? But it is not ROU anymore. Since you purchased the asset, now it becomes your PP. Now. So you'll have to reclassify this. From ROU, you'll have to show it as PP now. Same value. From 21,87,562, from ROU, you will reclassify it to PP. That's your reclassification entry. That's all. Okay, these are all your calculation in the entry part. Pretty basic only, right? This is the only new concept over here that we need to remember. We don't have any future cash flows, so that payment itself becomes what? The new lease liability balance. This one should click, right? If this clicks, rest everything you already know. Okay. Now one more requirement they asked us first year, no? This particular transaction ka impact in balance sheet, P&L and cash flow statement. First balance sheet impact. First year in balance sheet, ROU will come from this value, LL will come for this value. It's an extract, so you don't have to give the extract format. Lease liability and ROU balance. Okay. In P&L, two components will go, finance charges and depreciation. Finance charges for first year is this. Depreciation for first year is 13,01,920. That's it. In cash flow statement, you're making a payment now. 8 lakh lease rental you're paying. Since you're treating this lease as a lease liability, right? So it's a liability getting repaid, right? It's like a loan getting repaid. Loan repaid is what activity? Financing activity. So when you repay the lease rental, it will be treated as a loan repaid and it will come under financing activity. This 8 lakh ka payment you will show under financing activity as a negative because cash is going out. This is your impact on P&L balance sheet and cash flow statement due to this particular transaction. Easy only, but yeah, again, once at this, I think you can manage with the review. Not much there. But we have done similar questions, just that instead of buying it in fifth year, you purchased in third year. The early has happened. So that effect only is what we have to give it as extra in this question. Rest everything is pretty straightforward. Okay, G, welcome. Come to the last question of our RTP. Ind AS 102 ka share based payment. Now, Max company, they've entered into share-based arrangement with their employee. Each employee will receive 500 shares if they have remain employed for 5 years. Vesting period is 5 years. Each employee will get 500 shares. Okay, so far that's what we've learned. Next, it is expected that no employees are expected to leave. All options will get vested. Grant date fair value is rupees 4,000. Sir, they did not give fair value of one option. They gave the grant date fair value of the award only. Award means total option. Total option ka fair value itself is 4,000. This is not fair value of one option. This is the fair value of the award. Of all the options put together, the fair value is 4,000. And we know this fair value is nothing but the expense that we'll have to book over what? Vesting period. How much is vesting period? 5 years. This fair value of 4,000, you will book it over 5 years, means 800 expense you will have to book every year. So far, yes. Yeah. If an employee leaves the company, that is Max Limited, after 5 years, but before the shares are listed, then the entity has an option to purchase the shares for fair value from the employee. Now, people, once the employee serves in the company for 5 years, he is eligible to get the shares. That is one part. Now, the same agreement has one more clause. What clause? After serving 5 years, okay, employee will get the shares. After getting the shares, if employee quits the organization, after getting the shares, that is after working for 5 years, if employee gets the share and later quits, and if this company is not yet listed, company is saying, I will buy back the shares from you. If you leave my company after working for 5 years by taking my company ka shares, and if my company ka shares, if it is not listed in the stock exchange, then whatever shares the employee has purchased through this ESOP option, company will buy back at fair value. Okay, whatever is the fair value on the repurchase date, company will do. Okay, what is the significance of this? Now, people, initially it looked like a equity settled plan because company is giving equity shares. Correct? No. Now, the same equity shares company is buying back by giving away money. Because whatever is the fair value of that price, we pay it in cash and buy back those shares. So now what? It may look like from equity settle plan, we are going into cash settle plan. Because we are buying back those shares by giving away cash at fair value. So that is what they are trying to say over here. So this particular agreement also has what? A cash settle plan. So that means this is equity settle plan with cash alternative, sir. Sir, it is not an equity settle plan with cash alternative, because in equity settle plan with cash alternative, employee will have a choice. What choice? Either to take shares or to take cash. Hence, we do both accounting. We recognize SBPR also, SBPL also, share-based payment reserve and share-based payment liability, both will recognize. Here, employee does not have. The option is with the company only, right? They'll give you more data. Let's see what happens. Okay, if the company goes for this option from equity settle plan, it will become cash settle plan. Keep that in mind. On the grant date, the Max expects to list in the next 3 to 5 years. Company feels in next 3 to 5 years, we'll finish off the listing. This is the first SBP plan and the company has no past practice of the stated policy. Till now, we have not given any such plans to our employee. Or stated policy of buying back the shares from employee when the employee leave. Okay, we don't know. I mean, till now, we have not purchased shares from our employees also. Neither does Max expect that it will settle the award in cash. So companies with the belief that this is our first plan. Till now, we have not purchased any shares from our employee. Company feels in next 3-5 years it will be listed. Okay, even if it is not listed, we currently don't have any. Till now, we have not purchased the shares back from our employee, and they are also saying that company feels that we will not pay cash and buyback. Company is feeling that they will, though option is there, that clause is there. Company is of the opinion that we will not utilize this option. We will not give cash and repurchase those shares. That is what company is saying. That means what? It's very straightforward, simple arrangement. No, company will give shares to the employee provided they work for 5 years, and company itself is saying we have no intention to buy it back. That means it will become pakka equity settle plan. Then, though this feature is there, company feeling is saying we have no intention to utilize this option. Hence, equity settle plan. Okay, ji. Yeah. All right. This is one. Now, at the end of second year, Max Limited on longer. This should be no longer. Okay. Typo. At the end of second year, Max Limited no longer expects to list. Company is saying second year now we are in second year ending. Company is saying we will not get listed. And the employees are informed of this fact. We told our employee that we will not get our shares listed due to whatever reason. Max Limited announces to employees that if it is not listed after 5 years and employees leave, Max will repurchase the share and the fair value of the share is 6,000 on this particular date. Okay. Now, first year, initially and in first year, company is saying we have no intention to buy back the shares. So it was pure equity settled plan. Second year ending, may I don't know what Gyano Daya, what happened to company, something happened, okay, some twist happened. So now company is saying we will not get our shares listed, okay, and company and this fact also we communicated to the employee that we will not get our shares listed. Second one, company is also told their employee that after getting the shares, right, after 5 years, if you get the shares and then leave the company, I will buy back the shares. I will buy back your shares. That means now what, sir? Second year from equity settled plan, this will become cash settled plan. You'll have to change your accounting. Okay, from equity settled plan, you'll have to do cash settled plan. I'll just give you a quick summary of things. Then we will once again read and redo it. At the end of third year, the fair value of the liability is 9,000. Right now, sir, for equity settled plan, we only take fair value on the grant date. Subsequent changes to fair value is ignored. But if it is cash settled plan, at every reporting period till the time of settlement, we'll have to measure the liability at fair value because we have obligation to pay cash. No, since we have obligation to pay cash at every reporting period, you'll have to measure that SBPL, share based payment liability, at fair value. Second year, that liability value was 6,000. Now it has become 9,000. For 3 years, they're saying do the accounting. There's another fact, we'll read that later. Okay, let's do the accounting. So now just to summarize again, when the shares were issued, company said we will get our company when the shares were issued to employee, company was thinking we'll get the listing done, and even if we don't get the listing done, we will not buy the shares from you. Okay, on the grant date, company ka thought process was this. First year ending also thought process was same. Thought process of the company changed. Which year? Second year. Second year, company is saying we will not list our company ka share, and if you quit other company after 5 years, we will do the buyback. So for first year, it is pure equity settled plan. Second year ending May, from equity settled plan, it will become cash settled plan. So that accounting we'll have to do. Okay. Now, if it's equity settled plan, what we have to do? The total fair value of the option, you will book it over the vesting period, which is 5 years. That's what I've written here. Okay. 4,000 is the fair value of the option. Vesting period is 5 years. So first year, it's an equity settled plan. Company is not expecting to pay cash. Hence, it's a equity settled plan. So the journal entry you will pass is employee benefit expense account debit to SBPR, share based payment reserve, 800 rupees. Okay, G. Now, second year ending May, some twist happened. But first, let's book off the expense. Okay, second year ending May it has happened. No, so same employee benefit expense account debit to SBPR 800. This entry we have passed. Now, second year, what happened? Company is saying we will not list our shares. Hey, employee, if you leave us, we will buy back the share. That means from equity settled plan, now it will become cash settled plan. Okay, so if it is equity settled plan, we will recognize SBPR. But if it is cash settled plan, it is not SBPR, it is SBPL. So what we have to do? From SBPR, we have to reverse SBPR and transfer it to SBPL. Okay, so SBPR has how much balance? First year 800, second year 800. So SBPR has a balance of 1,600. So you debit SBPR for 1,600 to SBPL. Now don't credit SBPL for 1,600, boss. It's a liability, right? We are at the end of second year. So liability, you'll have to measure it at fair value. Second year, the fair value of the liability, they only given, how much is that? Where, here, second year, the fair value of the liability is 6,000. That means we'll recognize 6,000, right? 6,000 is the total value of that liability, right? But we have not given this option right now. Employee still has to wait. No, we are in second year. Waiting period is 5 years. So 6,000 is the total expense you'll have to book over 5 years. But we are in second year now. So 2/5 of the expense totally has to be booked. Or rather 2/5 of the liability totally we have to recognize. The total obligation is 6,000, but that total obligation is for 5 years, because only if the employee works for 5 years, he will get all this. Otherwise, he will not get anything, right? So 6,000 you have to recognize over 5 years. Why have I written 2? Because we are in the second year. So 2/5 of this we should recognize. So the value of the liability is 2,400. Okay. SBPR debit 1,600 because SBPR has balance of 1,600, but we have to recognize liability of 2,400. Recognize the difference is the gain loss, transfer it off to SPL. Okay, all these are employee benefit expenditure, right? It will be accounted through SPL only as a balancing figure. Okay, sir. I think here there is a typo in ICAI solution. They have passed the entry SBPR to SBPL 2,400. I feel that is wrong because you don't have 2,400 in SBPR. You have only 1,600. No. When you have 1,600, how can you debit 2,400? I think this is the entry that should have been passed in my view. But ICMA solution, I think it's a typo and this is what they have passed. Just wanted to call it out. Okay, Ji. All right. Now what's a third year? Liability value same, no. Second year it was 6,000. Third year ending में the liability has become now 9,000. Same drama. Okay. Liability value has changed means if it is a cash settle plan, you'll have to measure SBPL at what? At fair value at every reporting period. Now check how much liability should be in your books. 9,000 is the value of the liability. You have to book it over 5 years, but you are in the third year now. So 9,000 into 3 by 5 if you do. How much is that? Yeah, some value you will get. Okay. 1 minute. 5,400. 5,400 should be the value of SBPL in our books. The required balance of SBPL is 5,400. That should be the balance in our books. But currently we have how much? 2,400. SBPL balance should be 5,400. But we have recognized SBL last year only for 2,400. So 5,400 minus 2,400 if you do. 3,000 additionally you need to increase your SBPL balance by. So the entry will be, you have to book that as an expense. So employee benefit expense account debit to SBPL 3,000, 3,000. This is the value of liability required. This is what is existing. So from 2,400 you have to make it to 5,400 by increasing the liability by 3,000. We have done all this. There's a regular question. Yes or no? This is the first requirement of the question. Journal entry for 3 years. Okay. First part of the question. Okay. Simple enough. Okay. Now let's go through the second part. Second part is theory, but still a good twist I could say. Okay. What would be the treatment of awards? Now this is done. Okay, now it's a if scenario. Now they want to change some data and they are framed in another question. What would be the treatment of the awards if at the end of second year, Max does not inform the employee that it will repurchase the share after 5 years and listing of the shares are still achievable? So previously what they told, when you came to second year, company is telling we will not get the shares listed, and this fact we told our employee. And we also told our employee, if you leave after taking the shares, I will buy back your shares. That is what we had told. Now this portion they are modifying. Now they are saying second year mein company Max does not inform the employee that it will repurchase the shares after 5 years, and the vesting is also possible. That means what? If you don't communicate that the listing will not happen, share repurchase will not happen, then what will be in company employee ka mindset? Employee ka mindset will be, I will get shares and I can keep those shares. Company will not buy back those shares from me. So in that case, what? For year 1 to, okay, maybe I'll read off these things. And listing of entity shares is also still achievable. That's one part. But at the end of year 6, Max Limited is not yet listed. Okay, this is 6th year ka drama. Leave this. So that means second year, third year, fourth year, fifth year, anything has changed? No. The fact that the shares will not be listed, we have not told our employee. And we have also not told our employee that we will repurchase your shares. That means, will there be any obligation? No, because employee is full kush. He's like, I'll get shares, as simple as that. So in this case, when reading the first part, what will you get? If this is a scenario, means we don't have to book a liability because we don't have obligation. We have not communicated. Once you communicate, right, you will have to pay because constructive obligation will arise. So you will have an obligation to pay cash. So hence you have to account it as cash settle plan, because when you have an obligation, it should be cash settle plan of SBPL accounting should be followed. Hence, since we did not do that for 5 years, in that case, what it will be? For first 5 years, this plan will be equity settle plan only, because there is no obligation. Since we have not done any announcement, there is no obligation. From year 1 to year 5, you will book it as equity settle plan. Basically, this journal entry you will pass. For how many years? 5 years you will pass. Okay, because we have not communicated. Now, 6th year, what did the company do? Check. But at the end of 6th year, Max has not yet listed. Company did not get listed. Vesting period over. 6th year came. 6th year ending came. Company shares not listed. 2 employees left. There are many employees. In that 2 employees left, Max Limited exercised the settlement choice and buys the living employees ka shares at fair value. At the end of 6th year, shares were not listed, but 2 employees left. And company has a choice. What choice? If any employee has left, right, after collecting the shares, but if the company ka shares is not yet listed, company always has a choice to buy those shares at fair value, right? The choice was there. What did the company do? At the end of 6th year, since 2 employees left, company purchased their shares back. They purchased their shares back. Okay. Now people, constructive obligation will arise. Why? Sir, if two employee ka share repurchase company did means, what will the other employees think? Now, if I quit, my shares also might get repurchased. Yes or no? So, if this scenario may, okay, for first 5 years, obligation has not arisen. So, you will account it as equity settled plan. But in the 6th year, since two employees left and company repurchased those two employee shares, a constructive obligation may arise. Okay, once constructive obligation has arisen, a liability is there. So, from equity settled plan, we'll have to shift it to cash settled plan. Meaning from SBPR, we'll have to shift it to SBPL, same accounting. Here the values they have not given, we'll have to keep it at theoretical level. Little yarn, blade you'll have to give, that's all. Okay. So year 1 to year 5, no obligation, equity settled plan. Since obligation came in 6th year, from equity settled plan, shift to cash settled plan. Okay. From SBPR, shift to SBPL. That's what we'll have to do. Value not given. So leave it at theoretical level. That's it. Yes, people, I think that's pretty much with respect to this particular RTP. Hope the session was helpful to you. Wish you all the very best. Take care.